For Morningstar, I'm Jeremy Glazer. U.S. GDP grew only 0.2% in the first quarter, much lower than expectations. I'm here with Bob Johnson. He's our Director of Economic Analysis. Take a closer look at this number and also see what it could mean for growth for the rest of the year. Bob, thanks for joining me.
Great to be here today.
So this 0.2 increase was below expectations that were already pretty low, given some of the problems weather problems in the quarter. What's your take on this number? Is it a sign that the U.S. is headed towards a recession or a major slowdown?
Absolutely not. You can't just take one quarter out of context at all. And this is not the beginning of the end, so to speak. I think this is a very seasonal issue. I think, as you mentioned, weather was an issue. There was an issue with the ports that was also in the number. And then you had the energy situation, all holding down and weighing back on the GDP calculation. Many of those items hopefully will reverse themselves in the future. Unfortunately, the energy situation and some of the import-export stuff may not easily reverse itself, which will kind of hold things back a little bit going forward, so we won't have as big a bounce as last year.
Now, this is a number that's a sequential and then annualized. Is that really the best way to look at the GDP, or do you think that there's a better way to maybe put it in context?
Well, it's one way, and I think you have to look at several different ways. And one way is to compare the same quarter to the quarter a year ago. That gets out some of the seasonal variables in the numbers, and that sometimes helps make the numbers make a little more sense. And we're up 3% year over year on that metric, and that's really good. That's kind of one of the best levels of this recovery, to have one quarter over the one a year ago up that much. But remember, last year was even worse than this year in terms of weather, so it's a little bit of a help. So maybe the underlying is a little bit less than the 3, but it's certainly something in that range. And then another even better way is to roll 4 quarters together. It's easy to have one quarter impacted by weather, but when you roll a whole year's worth, it becomes a little bit harder to mess up the numbers. And even that number is up over 3% year over year when you roll the 4 quarters together and then compare it to the previous 4 quarters. So that's a pretty good growth rate. So there certainly doesn't seem to be any reason to panic here.
Let's take a deeper look at the numbers. You're always talking about how the consumer is so important. What did consumption look like in the first quarter?
Yeah, consumption's about 70% of the calculation. If you kind of know what's going on in consumption, you've got a pretty good feel for what's happening with the rest of the report. And consumption ran just under 2% in the quarter. It had been running more like 4%. It was a bad quarter for autos in particular. And in general, consumers, I think, were a little bit more cautious than many people had anticipated they would. I think we got the benefits of lower oil prices, but on the other hand, we lost a lot of oil workers, and things happened in various real estate markets that probably slowed things up a little bit. So that certainly hurt consumption, and that was the biggest reason why, even going into the quarter, that we were so scared about what the number might be, was the consumption number would be bad. The good news is that number is likely to get better with better weather.
Now, looking at the import-export numbers, a lot of things happening there with the stronger dollar, with some of the port issues. What impact did that have on the calculation?
Yeah, I mean, the overall contribution, it took 1.3% off of the calculation. So we would have been up more like 1.5% or something like that. Still not exactly a wonderful number. If you exclude the exports and imports from the situation, the government made a particularly large assumption on imports, which hopefully gets partly revised when we see the real numbers for the March imports. But clearly that weighed on the calculation. We had thought that the number would be bad. We thought it'd take 1% off of the GDP calculation, but they added an extra dose of caution to their numbers, and it was down 1.3%. So that's a pretty negative contribution.
How about business investments?
Business investment overall didn't have a huge impact, but there was one category that's really worth focusing on, and that's the business structures. And it's not the buildings that you'd think of, although that wasn't a great quarter either. We were down in that category. But the big deal was that oil wells count as a structure, and so business structures were down 23%. That's kind of on that annualized basis, which means they were down 5-6%, and then we multiplied by 4. But still, that's a big number to be down in that structures category, and that probably overall took 0.8% off the GDP calculation. We'll probably have some continuation of that slowing, but at some point this year even, I think that should stop.
And how about inventories? Does that have a big impact?
Yeah, inventories had a big positive impact. It was the one piece of well, I guess you can't really call it positive news, but it was one of the big positive contributors that we weren't expecting. It added 0.7% to the GDP calculation. So without inventories, we would have had a down GDP report. So that was kind of unusual to have inventories make that big a contribution. A year ago's first quarter, inventories actually took away from the calculation. Then we had a big bounce in the second quarter. Unfortunately, this year it's going to be the reverse. Inventories were a big help in the first, and they'll probably hurt us in the second and take away some of the benefit. But clearly, with inventories helping that much, it kind of makes for a lower quality report, if you will.
Then finally, what was government's contribution?
Yeah, this time government did next to nothing for all practical purposes. I think it added 0.2%, or took away 0.2%, which is better than it's been. But certainly we're not adding in government employees, and giving employees are the biggest factor in calculating the government contribution. It's not better, it's not getting better right now, and it's been one of the things really holding back the economy.
You mentioned that consumption could potentially bounce back as the weather gets better. When you look at your forecast for next quarter, should we expect the kind of big bounce that we had in second quarter of 2014?
Well, recall that last year we went from a -2 something to a +4 something in one fell swoop. This year we're going to start from a higher base of 0.2. I think we'll have a bounce to say 3 to 3.5%, which will still be a nice bounce. I'll take it. But I do think that the big inventory swing this time around is going to be negative instead of positive. So that's going to mean the number isn't as good as it looked last time around. And certainly I don't think we're kind of finished with the slowing in the energy sector just yet. But consumption, on the other hand, will look a little bit better. And housing should certainly look a little better too, I hope.
And so on that housing front, are there signs that housing is actually starting to improve?
Yeah. Well, in this quarter, housing net added very little. It grew about 1%, which means it added nothing mathematically to the number. You take a small percentage of GDP and multiply by only a small gain, and it amounted to nothing for all practical purposes. Recall existing home sales were down. Maybe we were a little better on the actual building of houses, not a lot. And I didn't have a chance to check the remodeling numbers, but those three components rolled up to kind of no change. And I think as we look ahead, those numbers are likely to get better, and we had some great signs of that today. Last week's column, we headed up and away for housing with a question mark, but certainly with pending home sales, had a really nice report today. Not only was today's number up over 1% sequentially, which is nice, but they significantly revised up the February number, so it had one of its biggest gains in history during the month of February. And so those pending home sales tend to predict existing homes 2 or 3 months out, and that tends to predict furniture sales and a lot of retail sales kind of 2 or 3 months after that as people move into those homes. So that was a really, really great piece of news that we got on Wednesday.
So for the full year, you think the U.S. economy can still grow in that 2.5% range?
Absolutely. I mean, I think some people are thinking it could grow a little bit faster than that. I'm thinking the bounce back may not be as strong as some people think. But I certainly think 2.5% is very doable. 3 might be a little bit tough.
So finally, does a report like this really change the Fed's calculus when they're thinking about potentially raising rates sometime this year? Does this really put that even potentially further on the back burner?
I think not. I think they'll be watching some of the labor reports and some of the other things going forward more than this. Certainly they've got a lot more economists working on the problem than me, and certainly they can look at the numbers in alternate ways besides this seasonally adjusted quarter over quarter multiplied by 4 routine, and they can look at the same numbers that says, gee, there's 3% growth to me if I look at it year over year. And so I don't think this report will be convincing. I think if we had a really terrible April employment report, that would clearly slow things up. But I still don't think they're in any great rush. This report certainly wasn't wonderful, so I think that may keep them at least until September, which seems to be the consensus right now.
Okay, Bob, thanks for your take today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.